Hi everyone, I'm going to break down the top 2 Canadian dividend ETFs you should consider buying in 2026. This list is for someone looking for stable and consistent cash flow. If you don't care for the cash and you just want massive growth, I would consider another group of ETFs. I recommended it here and I'll share the link as well. The top 2 Canadian dividend ETFs, based on my opinion, just right at the top of the video, are VDY and XDIV. Experienced investors will realize there's a lot of overlap and these are they're widely similar, but I'll explain my rationale at the end of the video. I think it's fine to invest in one or the other. You don't have to invest in both. Make your decision just based on the information that I'm giving you. Starting with VDY, created and managed by Vanguard. It is called the Canadian High Dividend Yield ETF, and obviously it invests in the top paying 58 or 59 dividend paying companies in Canada. This is Canada only. It is currently trading at $61 per share and it pays an annual yield of 3.53. So if you invest $10,000 today, you would make $353 per year or $29.40 per month since this ETF pays you monthly. However, you can start investing with just $100. Start putting $100 into this if you want and to start your dividend snowball. You can even reinvest the dividends if you don't need the cash to speed up the snowball effect. $100 can buy 1.5 shares. In Wealthsimple and in Questrade, you can buy fractional shares, so there's no wasted money. An ETF is a basket of stocks, so sometimes that basket is heavily weighted in one company or one industry. In Canada, our top 6 banks make up a huge portion of our economy and also our stock market. So this ETF has a 57% weighting in the financial sector, and it has 25% invested in the energy sector. If we look at the top 10 holdings, if you have $10,000 invested, you're indirectly investing $1,500 in Royal Bank, you're investing $1,000 in TD Bank and $700 in Enbridge. I'll touch on 2 more items when it comes to ETF investing. If you want to look at the historical performance and the management fees that you're being charged. So of course, the last 10 years of performance, it doesn't predict the next 10 years, but it's a good indicator of a tried and true strategy. So I try to find at least 10 years of performance returns to help make my decision. The last 10 years of VDY, you would have made 12.5% per year. If you invested $10,000 since the inception of the ETF, so around 13 years, you would have slightly over $40,000. The last item is the management expense ratio. This is 0.22%, meaning $10,000 invested, you're indirectly paying $22 a year. And I said indirectly because you're not paying for it yourself. It doesn't come out of your account. It comes out of the performance of the fund. 0.22 is probably the highest I'd pay when it comes to ETF investing, and the next one is a lot lower. If you have US dollars, you can invest in US ETFs, which usually have a lot lower management expense ratio. If you look at something like SPY or VU, I think those are 0.03. So you see the big difference there that can add up over 20 or 30 years. The second recommendation is XDIV by BlackRock. It is called the Canadian Quality Dividend ETF, and obviously it focuses on quality and the sustainability of dividends. They screen based on the profitability, earning stability, and financial health of the company. So this one is currently only holding 20 companies, and it is limiting the max exposure or the max weighting of each company to 10%. So no company can be more than 10% of the entire fund, which is different than the previous one I mentioned. It is currently trading at $36 per share, and they pay a dividend with an annual yield of 4%. So investing $10,000 will get you $400 a year or $33 per month because this one also pays monthly. I mentioned this one has a lower expense ratio than VDY. The expense ratio is 0.11%. So investing $10,000, it's indirectly costing you only $11 a year. Now you look at the difference when your portfolio hits $1 million or $2 million and you're investing for 30 or 40 years, if you can invest for that long, you see the expense ratio can significantly add up. This ETF hasn't been around as long, so we don't have 10 years of performance to judge, but in the last 8 years, this ETF has been increasing at 12% on average, which matches the performance of VDY. So if you invested $10,000 since the inception, so 8 years ago, you'd have over $26,000 in just 8 years. I mentioned at the beginning of the video that there's overlap. So looking at the top 10 holdings, you'll see some familiar names. RBC is around 10%. Remember, that's the max. TD Bank is 9%. If you invest in both, the overlap is fine. The industries are the same. Financials are almost 50% of the fund, and the energy industry is around 25%. I recommend everyone open an RSP and a tax-free savings account. I would always try to shelter your investments and your passive income. You can open both accounts on Wealthsimple or Questrade. I use both and I recommend both. They each have their ups and downs, but I'll probably break those down in a separate video. Now, if you need help deciding if you should invest in both, only do so if your goal is to combine yield with quality. You would add XDIV if you want to moderate or minimize VDY's volatility. I would not invest in both. If you already own another Canadian ETF, then there would be triple overlap, which stops making sense at a certain point. I would not invest in both if you want to diversify outside of Canada. This is Canada only, and I do recommend some global ETFs that I mentioned in a previous video. Again, I'll link it if you're interested. I'll leave the decision up to you, and it's up to each individual investor. Do you think investing purely in Canada is too risky? Are you bullish on Canada? Do you think investing heavily in the financial industry is too risky? Most of the Canadian economy is based on the top 6 banks. Personally, I don't own any of these ETFs. I actually don't own any dividend stocks. I focus a lot on options and options trading. I find I can make more money doing that, and I actually enjoy it more. I like being an active investor instead of a passive one, but that's too complicated and it's too advanced for these beginner videos and these beginner investors. Let me know what you invest in. Do you pick your own stocks to try to beat the market, or do you just choose these overall ETFs to have a safe and stable income? Thanks for watching. Let me know if you have any questions and tune into the next one.